Just this last week, the stock market has basically wiped out all of its gains for the past year. Everything is red, people are panicking, the markets are crashing, but I'm actually buying and we'll be going over why. If we take a look at the market, a ton of companies have been free falling over the past month. Shopify has fallen over 10%. ARK has dropped over 20%, and Tesla has been falling over 30%. And GameStop has fallen... Wait, GameStop's positive? I guess that means GameStop's a new hedge? All joking aside, with the recent market sell-off and all the markets being back to where they were near the beginning of the year, that doesn't necessarily mean it's signaling a market crash like the 1900s or 2008, even though the Nasdaq did briefly touch correction territory on Friday before rallying back into the close. So with everything going on, let's go over what's been happening, what's been causing these drops, and what you should and shouldn't do to turn this sea of red into a big opportunity. Hey, my name is Kevin, and on this channel, we talk strategies to help you along on your financial journey. Now, all I'm asking is for you to take this opportunity to hit that like button and help share this video with more people. Now let's get started. Now at this point, there's probably a ton of videos out there explaining in deep detail everything that's going on, but I'll try and summarize and simplify it here. Back in March of 2020, the economy was struggling. People weren't spending, people were out of jobs, stores were closing, and in order to keep the economy still up and running, the government needed to inject money into this economy, and the Fed needed to drop the interest rates down to zero. The reason this works is when interest rates are near zero, it pushes people away from saving and to spending instead, because it gives you next to nothing to save your money. Interest rates being near zero also means it's really cheap for people or companies to borrow money. For example, if it only costs you 1% to borrow $1,000, you probably would, because if you're a company, you could put that money to work. Or if you're an individual, you can spend or invest that money in the markets to give you more than 1% return and net you a profit. Basically, with interest rates being near zero, money is being spent and circulating, which keeps the economy going. So in order to keep the interest rates at zero, it doesn't mean that the Federal Reserve just comes out and says, okay, interest rates are zero. But in fact, they need to buy up what's called Treasury bonds. Treasury bonds are basically IOUs issued by the government in order to get money from others and pay back a small interest for that loan. Now, the interest that's paid out for these bonds is fixed, say the 10 and 20-year Treasury bonds. But the price people are willing to pay for these bonds is dictated by supply and demand. The more people that buy these bonds, the higher the price goes, and the higher the price goes, the lower the yield because the interest rate is fixed. For example, let's say you have a bond with a face value of $100 with a 1% interest. That means by holding onto this bond, you're getting a 1% yield. But people buy bonds for higher than face value. Say that drives the price up to $200. But because the interest rate is based off of the face value, that means that your yield is now 0.5%. Basically, the price of the bond and the yield are inversely correlated. So when the Fed wants to drop interest rates, they go up and buy up all these bonds, driving up the bond price, driving down the bond yield, dropping interest rates, meaning people are less incentivized to save and people and companies spend more. Remember, interest rates dropping also means that borrowing is cheaper, which means companies can borrow money for lower cost and invest back into their company, usually driving up the profits. With more spending going on in the economy, what could go wrong? Inflation. Inflation is bad because as people spend more, that drives the cost of goods up, which means it drops the purchasing power of each dollar you have. So it's really a balancing act that the Fed has to do to balance interest rates and inflation. With all that said, what happened recently to cause this market sell-off? With the economy picking back up, with a faster vaccine schedule, stimulus, people are hiring again, people are expecting inflation to come. With inflation coming, that's driving people away from safer investments like bonds, because if inflation is going to come with 2%, and bonds are only paying 2%, you're basically earning nothing for buying bonds, which is driving people to put money into more riskier investments like the regular stock market. But with bond yields going up, that means interest rates are going up. And with interest rates going up, that means it costs more to borrow, which leads to less profitable companies usually. With the recent Jerome Powell speech, people were expecting him to say that they were going to buy more bonds to keep the interest rates and things low, but that didn't happen, so the market sold off. A lot of these overvalued or highly growing companies were hit hard during the sell-off compared to regular value stocks. And that's because with value stocks, they're being valued based on what they're doing today. versus more risky growth stocks are being valued on what they would be doing 3, 4, 5 years in the future. Anyways, yes, it's weird. When the economy was doing poorly back last year, the stock market was doing amazing. And with the economy doing better now, the stock market is doing the opposite. So with everything going on with the stock market being down and all, what can you do to put yourself in the best financial position? First, stay calm. What the market is doing is just reacting to positive economic data and people thinking that yes, there will be inflation coming, but no one really knows for sure. What we do know for sure is there will likely be temporary inflation at least, given that the inflation in the last year was very low, say in 2020. So year over year, we're going to see a big spike in inflation. And second, we might see a spike in people spending and traveling because they weren't really able to in the last year due to all the lockdowns. Speaking of lockdowns, this is a good time to mention the importance of emergency funds. In the past year, millions of people lost their jobs cutting into their income. And an emergency fund would have been really helpful to help weather the storm and last them a few months while they try and get back on their feet. You might say that stimulus checks will help, and they definitely do. But with the past year and a ton of back and forth and debating, you can't really rely on just the stimulus checks. Or you could say that you would sell off your investments for income. But you probably don't want to be selling your investments when they're at a loss or when the stock is down a lot, because you're likely investing in them for the long term, and over time things will inevitably get better. Which brings me to my next point, to keep cash around in order to buy the dips. No one can time the market, and if you can, you're probably like a billionaire on your yacht watching this video somewhere. But the most you can and should do is to have a solid thesis and reasons why you're buying into companies. With these stock market dips or corrections, the fundamentals of the companies usually don't change, which means that if the fundamentals don't change, you should be buying more with these dips and treating them as fire sales or big opportunities to get in more in this company for a lower cost. But don't buy in all at once, because if you spend all your money buying the stock at the first dip, then you won't have any capital to invest as it keeps falling potentially. No one can really predict the bottom, so the best you can do is just average in and keep buying no matter the market condition. Lastly, stay diversified. Remember, in markets like these, a lot of capital is flowing out of higher risk growth stocks like your Teslas of the world into more safe investments like stocks and bonds. Different sectors could be impacted differently as well, especially the tourism and the airline industries in the past year. So by staying diversified, you're limiting your risk because then your whole portfolio won't tank at the same time. All in all, there's nothing stopping the government or the Fed from doing more of what they did in the last year, like more stimulus checks, buying bonds to lower the interest rate, or even relaxing requirements from the banks to let them hold on to less capital in order to spend it more. Now, none of this is financial advice, but I personally think that the markets usually overreact, and barring any other sudden changes, expect the market to come back sooner than later. But hey, if we look at the stocks from the beginning of the video, but over a 3-month period, things like Shopify, ARK Invest, and Tesla have all been in the green, meaning we've had a really good past while in the stock market. So a pullback like this is actually healthy for the markets. As Warren Buffett says, be fearful when others are greedy, and be greedy when others are fearful. And right now, people are fearful. Hey, thanks for watching and making it to the end of the video. Videos like this take a lot of research, as I'm definitely no expert in the inner workings of the financial sector. But by sharing this knowledge, I'm hoping that it'll help you be more prepared and be able to take advantage of opportunities as they come up. As always, if you found this video helpful, please like this video, subscribe to the channel, and comment down below with something you want to see me talk about next. Invest safe and see you in the next one.